Alphabet shares climbed over 2% today following impressive search monetization figures and AI infrastructure growth. Let's look at the numbers.
On July 22, 2026, Alphabet released a second-quarter earnings report that shattered every projection Wall Street had on the board. The company posted $119.8 billion in total consolidated revenue, a 24% increase from the same period a year earlier. This bar chart tracks Google Cloud's performance over time, and it highlights an 82% surge in revenue to $24.8 billion in just 3 months. When you pair those numbers with an earnings per share beat of $9.11, traditional market logic dictates that the stock price should immediately climb. Alphabet had produced the hard data proving its aggressive investments in artificial intelligence were paying off. For retail traders reading the headlines, the report looked like a clear signal to buy before a significant rally. Instead, the next morning, on July 23rd, Alphabet stock plummeted over 7%. In a single trading session, $138 billion in market value was wiped out. Investors hit the sell button because they saw a specific figure buried in the financials. Alphabet's free cash flow had turned negative for the first time since the company went public in 2004. That cash drain was the result of a deliberate choice. Management had raised their full-year capital expenditure projections to as high as $205 billion, funneling cash into physical AI infrastructure at a scale the market found terrifying. Yet the panic was short-lived. By July 27th, the stock abruptly reversed course, climbing back into the mid-320s despite the gloomy headlines. Institutional buyers drove this rebound, viewing the heavy cash burn as a strategic offensive where massive spending today secures a structural advantage for tomorrow. Over the weekend following the earnings call, top analysts ignored the market noise and started digging into the specifics of Alphabet's forward guidance. The result was a wave of institutional support. Wedbush added Alphabet to its best ideas list, while firms like Roth Capital and Barclays raised their price targets toward the $440 range. Their confidence centered on a single, easily overlooked metric, the Google Cloud backlog. Looking at this chart, the cloud backlog surged by $50 billion in a single quarter to reach $514 billion. This represents locked-in revenue from signed enterprise contracts, with management expecting slightly more than half to convert into cash flow over 24 months. Alphabet is racing to build enough capacity to capture $500 billion in signed demand, turning what looked like speculative infrastructure into a utility for confirmed customers. To capture that enterprise market, Alphabet's leadership is leaning on a structural advantage they have been developing for years. During the earnings call, Google Cloud CEO confirmed that existing enterprise customers are now spending roughly 50% more than their initial commitments. A major factor in servicing that demand is the Tensor Processing Unit, or TPU. By building its own custom silicon, Alphabet can control its AI computing costs better than rivals who are reliant on third-party hardware. In the second quarter, Alphabet reached a turning point, recognizing actual revenue from selling these TPU systems directly to customers outfitting their own data centers. By owning the hardware stack from the silicon up, Alphabet controls its margins and constructs a proprietary moat that third-party cloud rivals cannot easily replicate. To finance this expansion, Alphabet executed an $84.75 billion equity raise, the largest in its history. This capital is earmarked strictly for physical infrastructure, the massive data centers, specialized cooling systems, and network capacity required to train frontier models at scale. The most notable participant in this funding round was Warren Buffett's Berkshire Hathaway. A $10 billion private placement from Berkshire is a departure from the firm's history of avoiding technology businesses that require high, open-ended capital intensity. This injection of capital signals a deep conviction that investing in AI infrastructure today secures a durable market position rather than a temporary advantage. The institutional accumulation we saw on July 27th represents a re-rating by Wall Street on how to value mega-cap tech companies in the modern era. Investors are no longer viewing high capital expenditures and negative free cash flow as automatic signals to sell. Instead, this scale of infrastructure creates a multi-billion-dollar barrier to entry, effectively limiting the next era of high-end computing to the few firms capable of funding this level of capital intensity. Alphabet has the muscle to overpower short-term spending worries because Google Cloud's operating margin expansion proves the segment is evolving into a primary driver of the company's bottom line. Trading on headline panic is a trap. To find true value in this era, look past the cash flow statement, audit the confirmed backlog, and follow the smart money.